Hi, I'm Tim JK. I'm with Small Business Topics. Today we're going to talk about access to capital. Access to capital. One of the biggest things with small businesses today and years past is actually having access to capital. And what that really means is getting finance. And there's several ways that you can get finance. First of all, don't go to a bank. But today I'm going to talk to you another alternative banks you can go to look at getting finance. And it's not, if you're looking for example, $250,000, you need to break that apart, not to ask one lender to give you $250,000. So I'm going to introduce to you community banks, or I'm going to also introduce to you CDFI lenders. And those CDFI lenders, community development financial institutions, or nonprofits that the banks lend money to for people that's outside a banking criteria, if that makes sense. Everyone is not bankable. If you're a high net worth individual, you're bankable, or you have a big track record of existing businesses or a past business, you have a track record you can kind of lean on. Most people don't have that. So this is a way that you can get into the game with less credit, less resources, and they're here to help design you to become success. They only provide not only financials, but also they provide technical assistance if you run into some issues. They are usually partner with the SBA or the SBDC or SCORE in the area, and they're there to help you. Now, a lot of things are available, and counseling is available online. So I picked out Accion. They're one of the oldest, been around for about 60 years. And there's one community lender throughout the country that you have access to, at least in your state. So let's go ahead and begin. Let's talk about access to capital. This one I'm going to focus on really Accion. Accion in particular, I'm just going to take Texas because I live in Texas. Accion is actually represent New Mexico, Texas, Oklahoma, Louisiana, and they kind of lend regionally. Also in this area for Texas, we have PeopleFund, we have BCL, we have Liftfund, and several others. But your big ones are going to be PeopleFund and Liftfund in particular. What is so special by Accion and what they do? The banks actually give them a line of credit along with the Department of Treasury to lend out to socially economic disadvantaged people. Be minorities, it can be women, there are going to be those who with disabilities who probably don't have those resources to get financing. And this is a way for you to get financing. So bottom line, they're there to make loans. That's practical. And we're going to cover that today. They work to do microloans. Microloans are usually typically small loans under $25,000, and then regular loans goes up from that. But technically, in the banking world, a lot of banks do not make loans unless it's over $100,000. It's just expensive for them to make the loans. So a lot of them, even some community banks, would do the same thing. They want to make loans really the $150,000, $200,000, $300,000, but you have to qualify for that. So this is the gap to get you to be bankable. But so once you do a couple of loans with these organizations, then you'll be bankable enough to go to the next level because now you have a track record of paying on time, growing your business, and they can take you to the next level, the regular big banks. Also, these banks, meaning these institutions, also, they provide micro. They can provide regular small loans to up to $300,000. Some cases, $1 million when they include heavy assets or real estate. They also provide, like I mentioned, financial education and support, and marketing and networking and other opportunities for you. Accion in particular, it's the same at the other company as PeopleFund and Liftfund. They do low step loans of $500 to $1,000. They do from $1,000 to $12,000, and those decisions are made in 20 minutes or less than 24 hours. They can be funded. Also, lines of credit, which is $20,000 to $250,000, can range. And you say, what about I need a line of credit if you need to not factor, if you want to buy something seasonally and you just want to draw down the line for, like, for example, your busiest time is Christmas, you need to buy additional inventory ahead of time. And once Christmas is over, you pay all of that back and your line will be back to the same. It's like a credit card. You have $50,000 to spend. You spend most of that for your busy time of the year. And from that difference, you can go ahead and pay the card back because you have the funds. The term loan can range from typically 12 months, and it can range all the way up to 60 months. Commercial real estate can go up to $1 million. If you need to buy a building, I would say get a building today. It's going to serve you long term than actually renting a facility. Buy the land, and once you become in a situation that you can afford, instead of paying rent, you pay your own stuff and you own the property at the very end. And also the community advantage loans is between $50,000 to $200,000. What all banks look for is the 5 C's of credit. The 5 C's of credit: character, capital, capacity, collateral, and what the conditions are. Character, like it explains, the lender wants to know, hey, are you a felon, or are you just, or your credit is kind of shaky, it's been acting up on you? Are you paying your installment loans on time? Because that's what they're looking at. Hey, if you kind of shaky on your car note, and you might be shaky with our note. So that plays part of the character of you getting, for them to actually look at you repaying them. Another, also looking at capital. What are you investing in a deal? Do you have skin in the game? Do you have 20% in this particular deal? You can be a startup. They're going to ask for 20% equity. It doesn't mean to be cash. It can be assets. But they want to know, do you have some skin in the game as well? Also, what is capacity? Loan based on what your current income and your debt. Now, one caveat with this, keep in mind when it comes to capacity, you cannot use the loan proceeds part of your capacity or projections. They want to see, bottom line, do you have any outside income? So don't quit your job. Continue to do your job. And those extra funds that you have from that job would be part of your approval, will be your approval for your loan. So, for example, if you make $5,000 a month and you clear $1,000 a month, I would say cut your expenses off at least a couple months before you apply and show that you have $2,000 a month that's disposable. So you might can look at, hey, how much he's going to pay per month. Hey, we're going to cap him at $1,500 a month, and that leaves him $500 a month to spare. If that makes sense, okay? $5,000, your expenses are going to be $3,500. Are going to be typically $3,000 you're trying to make, and they say, okay, he needs to have some reserves, $500 for reserves for emergencies. The $1,500 can go to the loan payment. Then they consider everything else. If you have a spouse, it makes it much easier. You could just have additional money, and that gives you your capacity, what you can handle in loan payments. Your collateral, what you're buying, if it's all cash or it's going to be some collateral. Some of them want some collateral with it. They want you to buy something with it, even a desk or a computer, something that they have as collateral in the event this goes belly up. And the conditions overall, what the economic environment is doing right now with the interest rates. As you know, as interest rates go up, it's less that you can pay monthly. So your payment goes down, pretty much your payment goes up when the interest rate goes up, because then it's less you can afford. Moving on to that, now we're going to talk about in detail how the credit is actually made up. So the FICO score, the biggest lump sum of that is your payment history, as I mentioned earlier. Your payment history is important here. Your 30% of the whole credit report is 30% is really your payment history. So you make sure that you pay on time for the last 24 months. That's going to be taken into account. Also, how much you actually owe. So if your credit card's maxed out, your score is going to drop by 30%. Your credit history. how you've been paying overall over the course of the years. Have you applied for new credit and your types of credit? Do you have a mixture of installments? Do you have a mixture of credit cards? Do you have a mixture of other types of credit? So they want to see that as well. As I mentioned, you need to have skin in the game. They want to see you have 20% into the game. And what is your personal investment in the business? Which I mentioned, you have to put something in here. And what they're going to do is going to be your assets minus your liability, what your net worth is. And that's how they're going to actually figure out what your loan is. That's the capital. Your capacity, as it states right here, what is the financial capacity to take on extra debt? What is your available capital, meaning credit? What is your current debt load? What is your debt to income ratio? You take that mathematical equation, 2100, minus your gross income at 5200, and you come with 40%. It's the same thing we do with a mortgage. They look at the same thing, how much you have to really clear. Debt servicing, they look at this ratio as well. And it's really simple. If you propose a monthly debt payment of 1,000, you're servicing at 1.7 based on the number from the slide before. Your debt service ratio has to be at least 1.2. Okay. Collateral. Back to the 5 CCs. Again, they want to see some type of collateral, and that's pretty much just self-explanatory. Also, what's the business conditions that you're going to be in? Have you have a business plan? Do you have a person that you're working with in counseling? What are your source of funds? What is the trends in the industry? Is it construction, housing, trucking, so forth? Here's a loan from a food truck. Hey, they're doing a $12,000 food truck. They can either do what they did is they purchased a food truck separately and they asked for $12,000 for payroll, a new grill, a camera, and marketing. That makes sense. He financed it himself. That's part of his equity. He can afford that, and then he just asking for the working capital. And other than that, there's like here in the Dallas-Fort Worth area, Houston has the same thing, Austin has the same thing, and many other cities. They have a small business development center sponsored by the SBA. Those services are free. The SBA services are free. SCORE services are free. Then it has some other nonprofit groups are there to give you services free as well. So in a nutshell, this is really what a nonprofit lender does. So if you have any questions about this, you can kind of reach out to me, Tim Jacquet, with Apple Community Development Corporation. We're a nonprofit. You can reach out to us at 817-484-0212, or you can go ahead and email at tjacquet, first initial last name, at applecdc.org. Look forward to speaking to you soon. Take care, and thanks for tuning in.